We're jumping straight into Rocket Lab today.
Hey.
Everyone is watching the price action, but the real story is its massive $510 million backlog and the booming demand for its end-to-end space systems.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Yeah, and before we really get into the weeds today, make sure to subscribe and hit the like button. It really helps simplify your investing journey and ensures you never miss out when we break down these, pivotal market shifts.
Absolutely.
Because today, I want us to cut entirely through the noise. The space sector is incredibly loud.
Oh, yeah.
It's filled with all these promises of sci-fi futures, but as investors, we have to look at the reality. So we're going to tease out both the massive, tangible growth this company is experiencing and, frankly, the very real execution risks they are facing right now.
That's the perfect framing. And it's great to have you listening today, because in a sector that is just so driven by hype, the fundamentals are often completely ignored. Like, anyone can burn billions of dollars to build a rocket.
Sure.
The actual test is whether you can build a sustainable, efficient business model around it.
Well, those fundamentals are exactly where I want to start, because the revenue growth and the efficiency numbers we're seeing for 2025 are pretty striking.
They really are.
Just looking at the full year revenue for 2025, Rocket Lab hit $602 million.
Yeah.
That's a 38% jump year over year. And if we zoom in on just the fourth quarter, they brought in a record $180 million,
Right.
which is a 36% increase from the previous year. So these aren't just incremental gains, that is explosive top-line growth.
Definitely.
But I'm always a bit skeptical when I see numbers like that in an emerging sector. I'm curious how much of that is sustainable growth versus just, one-off contracts.
It's a very fair question, and to answer it, you really have to look at how that top-line growth is translating down the income statement. So by the third quarter of 2025, their gross profit had nearly doubled to $140 million.
Wow. Okay.
Yeah, that signals some serious operational efficiencies kicking in. It
Yeah.
means they aren't just buying revenue, their margins are actually improving as they scale up.
Right, which is exactly what you want to see.
Exactly. But perhaps the most crucial metric for a capital-intensive company like this is the balance sheet. Rocket Lab currently operates with a debt-to-equity ratio of just 0.23.
Which gives them a very distinct capital advantage, especially in the current macroeconomic environment.
Precisely. With a debt-to-equity ratio of 0.23, they are largely insulated from the high interest rate environment that is currently strangling other speculative tech and space companies.
Yeah.
They rely much more on equity than on borrowed money. If you look at legacy aerospace players or even highly leveraged competitors.
Like Virgin Galactic.
Yeah, exactly. The cost of servicing that debt can completely wipe out their research and development budgets.
Yeah.
But because Rocket Lab isn't suffocating under debt payments, they have the strategic runway to aggressively fund their capital-intensive growth initiatives. They can play the long game.
Let's break that down even further, because when we talk about their competitive moat, it's not just about launching rockets into the sky, it's about their space systems segment.
Right.
That segment alone exceeded $402.7 million in revenue. That's the lion's share of their top line, far outpacing just the launch revenue itself.
And if we connect this to the bigger picture, this is where Rocket Lab separates itself from being just a delivery service.
Mm-hmm.
They've built an end-to-end capability.
Yeah.
Yes, they have the Electron rocket. It's a phenomenal piece of engineering. 81 successful launches, over 248 satellites deployed.
Which is an incredible track record.
It is. But the launch is really just the delivery truck. The real moat
Yeah.
is in building the cargo. Rocket Lab has systematically acquired and developed the capability to build the actual satellites themselves. I mean, the satellite buses, the reaction wheels, the star trackers, the solar panels, the flight software.
So they're essentially becoming the one-stop shop for low Earth orbit infrastructure.
Exactly. And by offering that entire package, they create incredibly high switching costs. Think about it from the perspective of a commercial satellite operator.
Okay.
If you design your entire space architecture around Rocket Lab's proprietary components and flight software, you can't just easily take your business to a competitor next year just because a cheaper rocket comes along.
No, it'd be a nightmare.
Right. The engineering friction, the recertification process, the operational risk of switching, it's simply too high. Once Rocket Lab gets a customer into their ecosystem, they tend to stay there.
And those customers aren't just commercial satellite operators beaming broadband either. We're seeing some major defense wins and future tech developments that are completely transforming the narrative here.
Yeah, the defense side is huge.
Specifically, I want to talk about the HASTE program. They just had their second successful test in 3 months for the U.S. Defense Innovation Unit. And for the listener who might just see the headline, HASTE stands for Hypersonic Accelerator Suborbital Test Electron. It's a modified version of their workhorse rocket, but instead of putting satellites into orbit, it's being used as a test bed for hypersonic technology.
And this is a critical pivot for them. Developing hypersonic capabilities, vehicles that travel at Mach 5 or faster, is a massive priority for global defense departments right now.
Absolutely.
But the bottleneck hasn't just been the technology itself, it's been the testing.
Right, because you can only learn so much in a wind tunnel on Earth.
Exactly. To actually test the thermal dynamics and the guidance systems of a hypersonic glide vehicle, you need to launch it into suborbital flight conditions. Traditional missile tests are astronomically expensive and slow to organize.
Right.
So Rocket Lab essentially raised their hand and said, look, we already have a reliable high-cadence rocket in the Electron. We can modify it to give you the exact suborbital flight profile you need at a fraction of the cost.
Which completely explains why the Defense Innovation Unit is leaning on them so heavily right now.
Yeah.
But beyond defense, there is another futuristic development tucked into their space systems segment that caught my eye. They are developing silicon solar arrays specifically designed for gigawatt-scale space data centers.
Yes.
I mean, this takes the company far beyond just weather satellites and imagery. This is about next-generation global infrastructure.
It's a highly visionary play. Right now on Earth, the biggest bottleneck for artificial intelligence and cloud computing isn't processing power. It's energy and thermal management.
Yeah, data centers are incredibly power-hungry.
Very. And cooling them requires vast amounts of water and electricity. The theoretical solution that the aerospace industry is working toward is moving those data centers into orbit.
Because in space, you have access to uninterrupted, unfiltered solar energy 24/7.
Exactly. And the ambient temperature of space helps with the cooling. But to power a gigawatt-scale data center in orbit, you need solar arrays that are highly efficient, radiation-hardened, and capable of being manufactured at scale.
And Rocket Lab is positioning itself to be the premier supplier of that exact technology.
They are.
And all of these capabilities, the satellite components, the HASTE program, the solar arrays, feed directly into that market momentum we're seeing. When you combine the commercial demand with the defense contracts, you get that $510 million backlog.
Yeah, the backlog is the real story.
It's a 56% year-over-year increase. And for an investor, a backlog like that provides immense contracted revenue visibility. It takes a lot of the guesswork out of the next few quarters.
Right.
And because of this visibility, analysts are aggressively adjusting their models. Cantor Fitzgerald recently raised their price target on the stock from $72 to $85 as of March 2nd, 2026.
Well, the backlog is the anchor for that kind of institutional confidence. When an analyst looks at a company like this, they aren't just looking at what happened last quarter. They are trying to model cash flows 3 to 5 years out.
Sure.
A $510 million backlog means that even if new orders completely dried up tomorrow, which they aren't, the company still has over $500 million of work to execute and bill for.
But that brings up a really interesting dynamic regarding who is actually buying and selling the stock right now. On one hand, we're seeing heavy institutional buying. The smart money is accumulating shares, which usually signals long-term conviction.
Right.
But at the exact same time, we're seeing some insiders selling off portions of their holdings. Now, I know seeing insider selling can trigger alarm bells for retail investors. How should we interpret this divergence?
It's a dynamic that causes a lot of unnecessary panic, honestly. You have to look at the context of the insider selling.
Yeah.
Often, executives and founders sell through what are called 10b5-1 plans.
Which are pre-scheduled.
Exactly. They're pre-scheduled selling programs set up months in advance. They sell for personal financial planning, tax loss harvesting, or simply to diversify their own portfolios so their entire net worth isn't tied up in a single volatile asset.
Right. If a founder wants to buy a house or pay taxes, they have to liquidate some shares.
Exactly. It does not inherently mean they believe the company is in trouble. The far more important signal is the institutional flow.
The big money.
Yeah. The fact that major funds are stepping in heavily to absorb those insider shares suggests that the big capital allocators see underlying value and momentum here. They're looking at the defense tailwinds and the space infrastructure boom, and they want exposure. Analysts are forecasting profitability for Rocket Lab by 2027, with net income expected to grow over 6-fold by 2028.
Wow.
So the institutions are building their positions today to capture that 2027 and 2028 upside.
But it's not all clear skies, and we need to be completely objective here. Let's shift gears because there are significant hurdles on the horizon.
Looking at the flip side, we have to talk about the risks, particularly regarding execution.
Yes. We have to bring up the elephant in the room, the delays with the much-anticipated Neutron rocket. For the listener, Neutron is supposed to be Rocket Lab's next-generation medium-lift launch vehicle.
Right.
It's reusable. It's designed specifically to carry larger payloads and compete directly for mega constellation contracts. And frankly, it is crucial to their long-term thesis. But the timeline keeps slipping.
Now, those slips are creating real friction in the market. In fact, these Neutron delays have completely overshadowed the recent earnings beats we just spent the last few minutes discussing.
Yeah.
We saw a post-earnings slide in the stock price precisely because the market absolutely hates uncertainty. Neutron isn't just a side project. It is the product that is supposed to drive the next major wave of revenue.
And it's not like building a bigger version of the Electron. Neutron requires entirely new engineering. They are developing a carbon composite structure and the new Archimedes engines completely from scratch.
Exactly. It is a monumental engineering challenge. But from an investor's perspective, the delays pressure near-term sentiment because they raise questions about the execution timeline.
Right.
If Neutron slips further into late 2026 or 2027, does that robust $510 million backlog start to suffer?
That's the fear.
If commercial customers get tired of waiting and move their payloads to a competitor who currently has operational medium lift capacity, that backlog could quickly become a liability rather than an asset.
And beyond just the timeline delays, there are broader profitability hurdles tying back to this development. You mentioned analysts forecasting profitability by 2027, but right now they are still burning cash.
Yes, they are.
The current earnings per share is negative 38 cents, although it is worth noting that the third quarter narrowed to negative 3 cents. But still, they are operating at a clear loss, so I have to challenge this. At what point does investing for growth become just burning cash with nothing to show for it? Is this extended cash burn a red flag?
It requires a very nuanced view of the aerospace sector. Building rockets and space infrastructure requires an immense amount of upfront capital. Right now, Rocket Lab is taking virtually all the proceeds from their space systems segment and that $510 million backlog, and they are reinvesting it directly back into developing Neutron and expanding their global launch cadence.
Okay.
They aren't offering dividends. They aren't doing stock buybacks to artificially inflate the share price. Every available dollar is going into future growth.
Which means the investor has to be incredibly patient.
They do. It definitely delays immediate profitability. But in this specific industry, if you stop reinvesting, you lose the race.
Right.
If they decide to cut research and development just to show a positive EPS this quarter, they will be left behind by competitors who are continuously innovating. So, strategically, it is absolutely the right move to keep funding Neutron. However, it remains a very clear execution risk.
They still have to build it.
They have to actually deliver a working rocket. The market is giving them some grace right now because of the strong backlog and the dominance of their space systems components, but that grace won't last forever.
What?
The Archimedes engines have to fire, and Neutron has to fly.
Okay, so with all of these moving parts, the impressive revenue growth, the delayed Neutron rocket, the lucrative defense contracts, what exactly should you, the listener, be watching for over the next 30 to 90 days? We've got a specific catalyst calendar to outline here.
Let's hear it.
First up, mark your calendars for late May 2026. That is when the next quarterly earnings will drop. And what you want to look for specifically isn't just the top-line revenue, but the continued conversion of that backlog.
That is the vital metric.
Yeah.
A backlog is only valuable if they can successfully build the satellites, launch the rockets, and recognize the revenue. You want to see that $510 million figure actively translating into cash flow without significant delays or cancellations?
Right.
The other major factor to monitor over the next few months is the broader macroeconomic picture. We are operating in an environment where rate cut expectations are causing a noticeable sector rotation.
Capital is moving around.
Exactly. As borrowing costs are expected to come down globally, capital tends to flow away from safe haven assets and back into long-duration, high-growth, capital-intensive stocks, which perfectly describes the space sector.
Right, that makes sense.
That is a strong macro tailwind. Furthermore, just looking objectively at the global landscape, current geopolitical conflicts are serving as a catalyst for increased defense budgets worldwide.
Including the U.S.-Israel tensions.
Yes. And because Rocket Lab has dual exposure serving both commercial clients and defense departments through programs like HASTE, they are uniquely positioned to benefit from this global defense posturing without being entirely reliant on it.
And then there is the wild card, the speculative catalyst that has everyone in the sector talking. There is an unconfirmed rumor of a SpaceX initial public offering filing in March 2026.
Yeah, that's the big one.
Obviously, we have to stress that this is strictly a rumor at this point, but if it happens, the ripple effects would be unprecedented.
It is a perfect case study in how market psychology and institutional capital flows work. We call this concept sympathy buying.
Sympathy buying.
Yeah. If a privately held giant like SpaceX suddenly files for an IPO, it will absolutely dominate the financial news cycle. It will validate the entire space economy in the eyes of mainstream conservative investors who previously viewed the sector as too speculative.
And not everyone will be able to get their hands on SpaceX shares.
That is the key. Institutional funds, retail investors, and sector-specific ETFs who maybe can't get allocations in the SpaceX IPO or who simply want broader exposure to the space infrastructure boom will start heavily buying the publicly traded peers.
So they turn to Rocket Lab.
Exactly. There is a scarcity premium on pure-play space stocks. A massive liquidity event like a SpaceX IPO could lift the entire sector, forcing index funds to rebalance and bringing immense trading volume right to Rocket Lab's doorstep. It is highly speculative, but is absolutely a trigger you need to watch.
Okay, it is time for the lowdown. Let's summarize the core dynamic we are looking at here. Rocket Lab has firmly cemented itself as a leader in the small sat and space systems market. They are boasting a hefty 38% revenue growth, a completely loaded $510 million backlog bolstered by high-margin defense contracts, and incredible financial health with a debt-to-equity ratio of just 0.23.
Yeah.
But they are actively wrestling with the very real execution risks of the delayed Neutron launch, which is burning cash and keeping them from immediate profitability. That is the tug-of-war happening right now between present execution and future potential.
It is the classic tension of a growth stock in a capital-intensive industry. And I want to leave you with a broader concept to chew on regarding this entire space infrastructure boom. We talked earlier about Rocket Lab developing silicon solar arrays for gigawatt-scale space data centers. I want you to really imagine that future for a second. Imagine a reality where the internet, cloud computing, and AI processing aren't just hosted in massive energy-hungry warehouses on Earth, but are actually orbiting above us, powered flawlessly by the sun.
It's amazing to think about.
If space infrastructure becomes just as critical as the cell towers, fiber optic cables, and servers sitting in your city right now, what does that mean for the companies holding the keys to low Earth orbit?
That is an incredible thought to end on, and it really reframes how we should be looking at these companies over a 10-year horizon. Remember to keep your eyes peeled for those late May earnings and watch closely for any surprise updates on the Neutron timeline, as those engineering milestones will be the true market movers. Thank you so much for tuning into the Easy Money Show, and we'll catch you on the next one.